Well, hello, fans of accounting for decision makers. Today's class is the first class with kind of note taking in it, and so we are learning accounting terms today. These are specifically financial accounting terms, and so you're going to want to go to page. You should be able to see it on. You might be able to see it on the bottom of this video, page 5. In at least this year's version of the handy handbook. And so first we're going to talk about why is accounting important? Why is accounting important for you? Well, one, accounting is how businesses keep score. Okay, so accounting is how businesses keep score. We know whether a good decision or a bad decision was made based on numbers, on accounting information. And so that is how businesses keep score. Therefore, accounting, this is very related to the first one. Accounting is the language of business. Okay? Accounting is, let's see if we can move that over there. Accounting is the language of business. And so, and it is the language of business precisely because it is how businesses keep score. And finally, accounting is used to make decisions. Okay? Accounting is used to make decisions. And this is super important. And that is important whether we are talking about financial accounting or managerial accounting. The terms that we're going to be learning today are really financial accounting terms. So you will see that here in just a couple of pages. But decisions, whether it be information within an organization or published financial statements, the reason it is valuable, why that information is valuable, is because it helps people to make better decisions. And those better decisions will hopefully result in a more profitable organization, a more successful organization. And that's really the goal of all this. And that's why we think it's really important for you to know a lot of this as well. Okay? So let's look at the next page. How has accounting been important in history? The first accounting textbook was written Pacioli, 1494. That is when the first accounting textbook was written. So that is pretty darned old, right? Pretty darned old. And so it has really helped the world since then. Most business progress has been accompanied by accounting information. And so the notes that I really, really wanted to have you all remember is that, first of all, good accounting produces trust, right? You need to trust, like if you invest in a company, if you invest in Apple or Ford or Coca-Cola, whatever company you might want to choose to support, in order to know how well that company is doing and how well your investment should be doing, you need to be able to trust the accounting information that organization is giving you in the form of their published financial statements. And also, just as importantly, accounting is necessary for accountability. And so you cannot hold the leadership of that company that you have invested in, you can't hold them responsible for their behavior if you're not getting information that you can rely upon, that you can trust. And this is true for businesses. Accounting enables accountability not only of businesses, but our governments, whether at the federal, state, county, or city level, that accounting information is just super valuable to evaluate the decisions of others and to help you determine whether or not you think they've made good decisions. Okay, so let us move on then to the next page. So we are moving on to, this is now page 7. Page 7 of the Handy Handbook. And I hope you all like the Handy Handbook, right? You're taking notes in here, having all your notes in one place. Hope you all wind up liking that. What is financial accounting? This is information for external users. Okay, information for external users, such as investors. If you invest in the company, basically anybody who's outside that organization that might have an interest in understanding what's going on inside the organization, such as investors. If you own stock, you want to know how the company's doing, right? Creditors, they want to know how that company is doing. Usually they'll make some sort of an assessment they'll make an assessment of how well that company is doing before they choose to lend them money. Customers might look at financial statements before they make a major purchase. I once had an uncle purchase plane tickets, fully prepaid plane tickets for a flight some weeks or months later. And by the time that flight was supposed to occur, that airline was out of business. And so, you want to, maybe you do want to take a look at the financial statements, make sure you think that company is going to be a going concern before you make a purchase that you're going to trust them to deliver on sometime in the future. Employees might want to look at the financial accounting information of an organization to determine whether or not they want to work there, whether they want to continue working there, whether they want to leave their job and look for something else. Okay, competitors would be interested in seeing the financial accounting information of an organization, and because competitors can look at it, that is one of the reasons why it can be. It's usually aggregated in such a way that it doesn't give away too much information. Regulators look at this information, and tax authorities can look at this information. Okay. Then what is managerial accounting information? Managerial accounting information is information for internal users. It's information for internal users. And who are those people? Usually those are managers. It's really anyone, but the person, these are the decision makers, right? Decision makers, people who are making decisions, they want information, and they want information that's going to help them make better decisions. So this is a distinction between financial accounting and managerial accounting information. We're going to learn a bit of both this semester. We're going to start first with financial accounting information, or financial accounting, and then later in the semester, the second half of the semester roughly, we're going to spend our time more on managerial accounting information. But the terms are really certainly the starting terms that we're going to be teaching you were stereotypically taught in a financial accounting class. And the more decision-making element we'll then learn a little bit later in the semester. Okay? Very good. Very good. Let's turn the page then. More on financial accounting, GAAP. And accounting, GAAP is not a clothing store. It stands for generally accepted accounting, generally accepted accounting principles. These are rules for how to prepare financial statements, and they must be followed by publicly traded companies. So if it's a publicly traded company trading stock on particularly U.S. Based stock exchanges, then they're going to they need to publish annual financial statements. They have to have those financial statements audited by certified public accountants. And generally accepted accounting principles are the rules, right? They're the rules that must be used when preparing those financial accounting statements. FASB stands for Financial Accounting Standards Board. Financial Accounting Standards Board. This is the organization that sets the rules. Okay, it's the organization that sets the rules. And you already heard me actually use this particular phrase today. CPA is a certified public accountant. And really there's not an S at the end of there, so I will erase that for y'all. Certified public accountant. Okay? And this is a license. These people have a license. And they have a license to make sure that when a publicly traded company publishes its financial statements, that those financial statements were prepared in accordance with GAAP. Okay, that's what a CPA does. And then, so that's that's financial accounting. Now let's talk about managerial accounting. Thankfully, this is what I think is fun. I'm primarily a managerial accounting professor, and what I think is fun about managerial accounting is that there are no standards. There's just good information to help people make good decisions. CMA stands for Certified Management Accountant. This is a certificate. It's not a license. The license is like a driver's license. A driver's license lets you legally drive an automobile, right? So a CPA license lets you legally conduct audits. CMA is not a license. It's simply a certificate, and it's a certificate that indicates that at one point in time, that person was smart enough to pass an exam, and in the meantime has tried to stay current with changes in the industry. So it turns out that I happen to be both. I've done both of these. I'm a certified public accountant licensed in the state of Texas, and I am, in fact, a certified management accountant as well. So at some point in time in my life, I passed a couple of fairly big tests. Okay, so awesome. Hang in there. If you feel like I'm going just a little bit too fast, please feel welcome to rewind and re-listen, because I am going a little bit faster than I might during class. Okay, let me get a drink of water here. So the next thing we're going to talk about are types of businesses. And because there are different ways a business can be organized, and very often, certainly how I'll be kind of defining these is a little bit about, one of the defining characteristics of these is who can be sued if something goes wrong. So this is, a sole proprietorship is a business owned by one person. Your local plumber, probably a sole proprietorship. And this person bears unlimited liability. If, for example, the plumber sets a house on fire for some weird and strange reason, that person is responsible for their behaviors. And that is, so the buck stops with them, as it were. And so they have unlimited liability for the debts of the business. That one person does. So that's a lot of risk, but it's potentially a lot of reward as well. Okay. Partnership is a business owned by two or more a business owned by two or more partners. And each partner bears unlimited liability. Okay? Each partner bears unlimited liability. So that means, well, for one thing, if you are going into business and going into business with a partner, you want it to be somebody that you can trust, because if that person does something wrong and then potentially skips the country afterwards, you can be sued for their wrongdoings. So every partner is individually responsible for the behavior, at least legally liable for the behavior of any of the other partners. Okay, it is curious that both accountants tend to use this organizational form a lot, as do lawyers, right? Lawyers will have partners, and you've seen a partnership when the name of the business includes just a long list of names, right? George and George. That's a partnership. And then finally, a corporation is a business organized as a separate legal entity. Who owns that business? It's actually owned by stockholders, right? If you own a share of Apple stock, you can say you are a part owner of Apple. And in order to make that whole system work, you'd be a lot less willing to buy those shares and invest in that organization if, when Apple did something wrong, you could personally be sued. And so it is a separate legal entity. Only it can be sued, not the owners who might own stock. And so very, very different than the other two, right? Here, the people represent it and represent the organization, and those are the people who will have legal liability for the behavior of the organization and what it does, whereas stockholders as owners do not. You separate you if someone were to make a legal claim against a corporation, they're making that claim against the corporation itself, potentially the managers within it, but stereotypically it is the corporation itself. So three very different forms of organization. And it is accounting that's really made this one possible, right? This doesn't happen. You don't have a 200,000 owners of Apple without some way to communicate with those owners the performance of the organization on an annual basis from year to year. And so that is what accounting does. This is an organization form that accounting has made possible. Okay. And let's talk a little bit more here. Investors. Here are some sources of funds for business. Money to start a business comes from basically one of two places. Investors, and these are owners. So that sole proprietor, those partners, they are usually the investors and stockholders, right? Stockholders are also fall into this category. So these are persons who have provided money to the business in return for ownership. Okay? Persons who have provided money to the business in return for ownership. Creditors are any person or business to whom a business owes money. You want to think banks, right? You want to think banks. So investors have given money for a share of ownership. A creditor wants all of their money back with interest, and that's how they're going to make money on their money. The owner is going to make money by having the business do well. Creditors are going to make money by receiving interest on the loans that they have made. So those are the two places that a business gets money. Gets money. Those are the two places that a business gets money. And that goes for all forms of business. Your local plumber might start with some money, buy some supplies and what have you, but then they need to borrow money to buy a vehicle. So that person would owe money to a bank and would have invested some of their own money in starting that business. Okay? And so we're getting there, aren't we? We are getting there. We've just got one more page to go, and then we are finished with this video. Okay? So financing activities. These are different types of transactions within a business. And I actually want to start at the bottom. This is 1, 2, 3 in order of frequency within an organization, meaning what happens the most within an organization? It is actually operating activities happen the most. These are transactions that relate to the primary operations of the company. Okay? These are transactions that relate to the primary operations of the company. Selling products and services or services, right? John Deere, they sell tractors and all sorts of other equipment. This is an operating activity. Producing and selling tractors to those who would purchase them, that is the operating activity for John Deere. So associated costs of products and services. Okay, so this is kind of what you sell and how you and the cost of making or providing those products. Those are operating activities. Investing activities are transactions involving the purchase and sale of long-term resources. Okay, now that's very interesting. I was just talking about John Deere, right? Let's talk about John Deere. Everything runs like a deer, according to them. Or nothing runs like a deer. There we are. Nothing runs like a deer, according to John Deere. From the perspective of John Deere, selling is a operating activity. From the perspective of the farmer, buying is an investing activity because that tractor lasts a while. Long-term means greater than 1 year. That's what long-term means in this context. And so that tractor sure as heck better last more than a year, shouldn't it? Because they spend a lot of money on them. There are $1 million tractors in the world. And so probably a lot of the tractors you see in fields anymore cost that farmer more than $1 million. So farmers want those to last many, many years. And so that is an investing activity from the perspective of the farmer. But from the perspective of John Deere, that's an operating activity because that's what they do. They make those tractors and combines and balers and all sorts of lawnmowers, all that sort of stuff. Okay? Let's go to financing activities then. And this is why we defined these terms on the last page, right? Transactions with investors and creditors, okay? Transactions with investors and creditors. So basically, getting money. These are financing activities, getting money to do things. And for a publicly traded company, that means issuing stock or borrowing money from a bank. Okay? Borrowing money from a bank. And so they do happen really in kind of reverse order from here, which is why I've kind of numbered them the way I've done and put a star by operating activities, because operating activities represent the bulk of what a business does. They do, any business, most businesses will have some level of investing activities just to make sure they have the equipment they need to do business. And then financing activities happens periodically during the life of a business, right at the beginning, usually, and then periodically perhaps throughout if they need a little bit more money, okay? So these are the types of activities of a business. And so that is where we're going to end today's video. And we're going to continue learning some more about terms. The next class is going to be on the types of accounts and then the types of financial statements that exist. So, and y'all, thank you for listening, taking notes, and look forward to seeing you in class and or the next lesson. So take care.